In finance terms, consolidation refers to the incorporation of the financial statements of all subsidiaries into the financial statements of the parent company. Consolidation of financial statements requires the parent company to integrate and combine all its financials to create a standard form income statement, balance sheet, and cash flow statement as part of a set of consolidated financial statements. In this video, we will talk about the income statement consolidation. To create a consolidated income statement, we would take the income statement values of the investor and the investee and add them together, and then apply transaction effects. First of all, we need to include only post-acquisition portion of the investee's revenue and losses into the consolidated income statement. Another transaction effect would be an adjustment of extra interest expense on deal debt and lost interest expense on retired debt. Also, we would need to adjust by the value of synergies from the M&A transaction. And we would need to make step-ups for extra depreciation and amortization on property, plant, and equipment and intangible assets. And take into consideration the tax impact of all of the above. Let's take a look at the example here. Trueback Incorporation has acquired Wallet Company for $1,500. The acquisition is 50% financed with debt. Expected synergies are 100 each year, and applicable tax rate is 30%, and interest on new debt is 6%. Using information below, provide the pro forma financials for the comp. So here are our inputs: acquisition price of $1,500, debt financing of 50%, synergies of 100, interest rate on acquisition debt is 6%, and tax rate is 30%. We already have sales, EBITDA, EBIT, and net income are given to us for both Trueback and Wallet Corporation, which is our acquirer and target, and we will need to make some adjustment and create consolidation for these values. So the adjustment for EBITDA and EBIT would be synergies that are given to us in the cell B9. It's 100. I'm gonna anchor that cell here so I can do shift down arrow and fill it down with the shortcut Control D. Perfect. Next is net income adjustments. Here we will take our adjustment of synergies, multiply it by 1 minus our tax rate, so we will adjust it by the tax rate, minus our acquisition price multiplied by debt financing, which is 50%, multiplied by our interest rate on acquisition debt, which is 6%, and multiplied by 1 minus tax rate again as an adjustment for the tax for the debt financing. Perfect. We have 38.5 as our net income adjustment, and now we will create a consolidation for those numbers, which is going to be a sum of adjustments and the original numbers for Trueback Incorporation and Wallet Corporation. I will fill it down with shift down arrow, Control D to fill down, and I can see that all the formulas flew perfectly, and my net income as a result would be 218.5 with all the adjustments made. Great job, guys. The next video will explain balance sheet consolidation.